And welcome to today's webinar, Making a Strong Business Case for the Bank. I'm Andrea Frost, and I'm part of the comms team here at the Capital Masters. We've got two brilliant panelists coming up. Bob Hernandez is the Treasury Credit and Finance Wizard here at the Capital Masters. And over the course of his career, Bob has analyzed and contributed to the closing of approximately $400 million in small business loans. Rich Russakoff is the acclaimed author of Make Banks Compete to Lend You Money, the definitive guide to creating a dynamic narrative and top-notch business plan that gives banks what they need to say yes. Together, this experienced team is going to discuss what you need to know and do before you approach banks for funding. Before I hand the mic over to our two experts, though, I have a couple of housekeeping items to cover. First, today's webinar is being recorded and will be available on demand after the live session. Second, we will be offering access to Otter Live Notes. You can either click on the red live icon on the custom live streaming service and then click on View Stream to open Otter Live Notes in your web browser, or we'll also paste a link to Otter Live Notes in the Zoom chat window. And once the webinar is concluded, we'll email you a link so that you can access the recording. Also, one last thing, we'd love to hear from you during our presentation today. If you have a question for our speakers, please feel free to send it through the chat tab at the bottom of your viewing window. We'll save the questions for the end of the session. And if we don't get to yours during the webinar, we'll be happy to do a call with you. So without further ado, I'd like to kick things off. Rich and Bob, over to you.
Thank you very much. And Lucy, would you bring up the first slide, please? The purpose of the program today is to make sure you're aware of and prepared for the dynamics in the banking community right now. What used to be is not what banks are doing currently. And we're not here to scare you. We're here to prepare you for what you might expect and what's different and how you need to know that there are things you can do to best position yourself, but be prepared because it's very possible that the bank that's worked with you forever may decide to call your loan if you did not do well during the pandemic, or if you're not in a position right now where the industry you are in gives the bank a comfort level. So let's go to the next slide. So Bob, let's take a look at this. Banks will focus on their customer, be open, transparent, and non-confrontational. So what's different about that from 2019 and now in 2021? Don't banks always focus on their customer?
Yeah, they do, Rich. Actually, however, given COVID and given all the dynamics and changes in the industry, the commercial banker, credit officer, underwriter is going to be looking at you maybe as if you had never been there before. They're going to scrutinize all of your metrics. They're going to relook at your financial statements, the strength of the guarantors on the loan, your overall performance, industry metrics, that is to say how you compare to your peers, what your industry is doing. They're going to really get granular and try to prove up and justify either the need for extending you credit or keeping you at the bank at all.
Thanks for the overview on that, Bob, because we're going to go deeper on all of these points. Lucy, bring up the next slide, which Bob alluded to. Share with us, Bob, what bankers are telling you about how they're assessing clients that are currently in their portfolio.
Well, one of the major points that comes up with every one of them is, Bob, if you're going to bring us a customer, make sure that we know what their COVID plan is and how they performed during COVID. That is a big aspect of what they're trying to assess. And in a lot of ways, they already know this for the industry, but they're going to need to know at a granular level, maybe week by week, how you performed, say from June through end of the year. They're going to want to know what your strategic direction is for this year, for the next 12 months, and how you fared overall. They're going to do a deep dive into those numbers and see if there's, if you just fell apart because of COVID, or, if you're in a decline, was it a natural decline within your industry, but you've been able to pivot and do some other things to keep yourself going? Did you take advantage of PPP and EIDL and other resources that are out there? They want to look at creativeness. They want to look at agility, as well as credit underwriting performance.
So Bob, we talked to a business owner in the EO community, Entrepreneurs Organization community, a couple weeks ago, and his business is Dunkin' Donuts, and he has great locations throughout a major metropolitan city, and he is an A player. But of course, it's breakfast and it's commuters, and all that stopped. So his bank approached him and told him, look elsewhere. And that's really part of this idea of treating you like a startup. So what would cause something like that, Bob?
Well, for one thing, he had a decrease of 43% in sales. Most of his and he owned about, I believe, if I recall, 13 Dunkin' Donuts and about 4 Taco Bells in the New York metro area. Most of his Dunkin' Donuts were downtown. So with COVID and everybody working from home, nobody's eating donuts downtown. So the 43% decline was a real hit to him and causing a cash flow crunch to where he was in jeopardy of maybe defaulting on a loan payment. So that, raised some eyebrows. And being that he has a substantial amount of debt, given his leverage, and he had great historical performance. I mean, the guy has an A-level operation, but he just got hammered in COVID. This particular bank is looking at a potential exit strategy for him, and they're within their rights.
By virtue of the contract and the covenants?
Well, the by virtue of being the lender and, the golden rule, he who has the gold rules, and that's usually dictated in the loan agreement.
So I'm not in the restaurant business, but I had a decrease of 25, 30, 40% during COVID. Is this a fire alarm for me to be aware of?
Well, if you're not aware of it, then you're either comatose or in another country, because that is something that you should definitely notice if you've dropped sales by that amount. If you've defaulted or asked the bank to defer loan payments, they may be coming to you to look at your financials and really do a deep dive and an audit of where you're at. A decrease of that large can put you in position for bankruptcy or even worse.
Let's look at the next slide. So I wrote a book on how to make banks compete to lend you money. And I understood what we needed to give the loan officer so the loan officer could pitch it to the underwriter. And now we're seeing, and when we put together packages for clients, our focus is not on the loan officer. It is on the underwriter. It is on the credit officer. What's the shift, Bob? What's the difference in how you would pitch to a loan officer who would then sell the package to the underwriter, and how you pitch directly to the underwriter?
Well, what we're doing is trying to make the life easier for the loan officer on the front end. We're as opposed to giving him a lot of narrative on the company and the borrowers, which we have. We're doing a verbal with him and having a meeting with the clients and that loan officer. But the loan officer is not the decision maker. He's a gatekeeper. He or she is a gatekeeper. That's it. The decision is going to be made behind the curtain with the chief credit officer or the head of underwriting or some team of signature authorities, or if you're old fashioned, maybe a loan committee. So you want to prep the package and put as much information in that that's going to cater to what they're really looking at, which is going to be, how is this loan being repaid? You know, what's the historical cash flow? What are the historical balance sheet and financial trends? What is the strength of the guarantors? How's the industry performing? You want actual metrics that they're going to be analyzing to determine not only the risk of the deal, but the repayment of that debt and the probability of that at the end of the day.
And those are the most important thing for the underwriter to make a decision.
Well, yeah, and the underwriter, it's a process. They're going to be going through those through the motions of analyzing all that, looking at tax returns, financial statements, industry analysis, you know, maybe even outside banking references and deposits, and you know, they're going to look at everything. They're going to write it up, pass it by the credit officer, and the credit officer is going to come back with some comments and maybe suggestions or likes and dislikes, and that underwriter will have to retool and present it. And if everything works at the end of the day, he's sending it up for signature or approval.
So everyone on the call will have access to the transcript of this call, so of this meeting. So what Bob just did was give you a checklist of things to be prepared to have. And if you can't put it together, where should they go to help on that, Bob?
To put together the package?
No, I'm talking about the specific things that the underwriter needs to see.
Yeah, they're not going to be able to go out there. That's an art. I've been doing this for 40 years, and I mean, that's the best help I can tell you is to get with your CPA and or your financial person, your treasury officer, or your CFO, and understand your financials. And that's balance sheet and income statement. Understand your trends. Know what your metrics are. I mean, you can readily get those if that's what you're referring to, Rich. But to understand what an underwriter is doing and how they do it, that's a job in itself.
No, what I was saying, Bob, is we're asking people to get this information for the underwriter. I'm an entrepreneur. I don't do this stuff. Should I be able to expect that people on my team and my professional advisors can put this together for me in the right format?
Possibly. I mean, that's what we do for a living for clients. But you can go out there to the internet and search Google for your NICS code, NAISC code, and drill down to get what your metrics are. But if you're running a business that's making, you know, over $1 million in sales, or even 500,000 or 10 million, you need to know this stuff. If you don't know it, then you're at a real disadvantage right now.
Okay, next slide. So what is a complete banking relationship, and how are banks assessing their customers' risk profile right now?
Well, a complete banking relationship would consist of deposits, loans, credit cards, treasury management, you know, a mix of interest and non-interest income products for the bank. Could be trust services, investment services, things like that. Risk profile is going to be the propensity for the deal to fail and for the bank to have to take it back on their books, or your propensity to, you know, go bankrupt or default on your debt. And that's all done during the underwriting. So they're going to be looking, the banks today are going to be looking at the whole relationship, which entails what's the profitability of this customer potentially, given the assets that we're going to have on the books, which an asset is a loan, or the services we're going to sell them, and does it justify from a risk and a profitability standpoint to bring this client on?
Or keep the client.
Or keep the client, that's true. There are some instances of late that we've run into where a client has come to us for help to to form a bank exit strategy.
And it's because they've done this analysis and there just wasn't enough there for them to keep the client in this climate.
Yeah, I had a client, and they're in the oil and gas industry. They've decreased 43% in their sales, and their existing bank just doesn't want to work with them anymore. So they're having to get an exit strategy to get out of there.
So that's what we're saying. Be prepared for just about anything. Don't assume that the relationship you had yesterday guarantees you a continued relationship with the bank that's willing to provide you with line of credits and working capital. Let's go to the next slide. So this is really key. And Bob, I know you love to focus on what's most important, which is the middle slide.
Correct.
And so how do I show the bank that I'll be able to repay the loan? And how does the underwriter make that determination?
Well, the underwriter is going to be looking at basically 3 levels of repayment. First level of repayment is obvious: cash flow from operations. You have sales, revenue, less cost of goods sold and expenses. You have a net income number. You add back your non-cash items, amortization, depreciation, and interest. That's your cash flow. Does the cash flow recover the debt at a given metric? Banks use different metrics to determine what cash flow is. Within the SBA world, the most common one is 1.25 times. In conventional banking, it could be 1.5 to 2 times. So it depends on the bank you're going to. The next level is going to be guarantor support. Is the guarantor liquid enough that in case the loan defaults, that we're going to be able to capture the amount of money we lent to the business from the guarantor? And then third, the tertiary, is going to be foreclosure on collateral. If there was no collateral, i.e. it's maybe a business acquisition or working capital, then obviously that's not there. So if there was real estate as collateral, then foreclosure of that real estate, does that cover the amount of debt that's remaining on the books? And in turn, they might be getting life insurance on the guarantor as well as another means of potential collateral in the event the guarantor has demise.
So obviously, if I'm the underwriter and I can't answer those questions to my comfort level, that in the event of a default, the client will be able to pay it back, I'm going to pass.
That's going to be a pass. And that's one thing that we try to do on the front end, is perform that level of analysis and pre-screen, as it were, that client. It's not a back of an envelope. I'm doing the same thing they do in underwriting. I'm looking at historical tax returns, profit and loss statements, receivables, payables, and guarantor financials, credit reports. I'm looking at all of that on the front end.
So if we take a look at that, and then one of the key factors is going to be how has the pandemic affected your business?
Correct.
So it's critically important that you be able to tell the best possible story on what's happened and what you've done about it. What are you suggesting, Bob, that people do there to best respond to this if it's been tough?
Well, if it's been, I mean, it's going to depend on the situation, but you need to be able to alliterate in a narrative format how you performed, and that could be with spreadsheets in addition to narrative during COVID on a maybe even a weekly basis, say between June to the end of the year, and compare that to 2019. And if there is a marked difference, then you know why that difference occurred. And yeah, you could say COVID-19, but I mean, it's maybe you're a restaurant and you're a sit-down restaurant. State and federal government mandated we shut down, so that's the reason for that. However, we've gone out and gotten PPP loans and EIDL loans to carry us through, which goes to another slide we'll get into about agility. But the bank officer is going to want to know, credit officer, how you performed during COVID. Were you able to pivot or do something differently to keep operations going? And then what's your plan for the next 12 months?
Okay,
Every banker I've talked to has been asking for that.
so let's go to the first piece of that. It's critically important that you specify why you need the money. Make that case as clear as possible. And then also the most important part is, what will it do for your business? And when we're working with our clients, we had a client say, I think $2 million would help us out a lot. And then we really doubled down on it, and we broke down exactly how they would use that money to the penny by category. What suggestions do you have on how to do that, Bob?
Yeah, it's very important that you're able to construct a proper uses of funds for the bank, and put them into specific buckets. If you have a need for working capital, explain the need. Well, we need 3 months of working capital to support training, to support insurance, rent, things like that. We need 150,000 for inventory. And put it in all those different buckets. We plan on getting a new audio visual system for our presentations. That's going to cost $200,000. It's really important that you segment out by major groups how you're going to use that money, what it's for, and the justification, which is going to dovetail into your projections and your assumptions as far as how that's going to benefit your company overall.
Thanks, Bob. To give an example, we're just finishing up a package now for someone who offers IT services. And right now, the team he has is made up of independent contractors. What he wants to do is hire people that work for him. The reason he wants to do that is because that will create higher profit margins for them, because they'll pay them less than they'll pay independent contractors. However, there are startup costs involved in terms of recruiting, training, bringing the right people on, bringing them up to speed, and then finally reaching a point where they will generate revenue for them. And we're able to show and document that in having that difference in margin, they become 20% more profitable. Anything you want to add to that, Bob?
No, that was great.
Thank you. That's the first time I've heard that from Bob, everyone. Let's go on to the next slide. So when I first started working with Bob, I don't know that I clearly understood the difference between know your competition and your competitive advantages, and do you know your industry numbers and where do you stand? Bob, let's talk about each one of them, and then we'll get to the middle slide, which is equally important.
I mean, knowing your competition is just, that's primary. The easiest examples are quick service restaurants. Who say you're a XYZ restaurant, and you alliterate that there's within a 1 mile radius all of the different restaurants that are around you. I mean, you just pull a Google Maps and it'll show you. But do you know all your competition in the area? Do you know anything about them? Do you know their sales? Do you know how many day parts they have? you know, how are your projected sales comparing against those guys? And are there enough choices around you that you're going to have ample propensity to have, you know, clients come to you to eat? Maybe they're tired of having barbecue or going to a, you know, craft beer place, and your Italian food, they want to try you now for something different. As far as industry metrics, totally different subject. You know, how if your sales are $1.2 million a year for your asset size, if you go to risk management associate or wherever you go for your industry metrics, and it says that you should be doing, you know, $1.4 million, then, you know, you're obviously below what is needed for that industry. And let me remind you that these banks who make loans to, whether it's franchise, high-tech companies, medical, agricultural, they know your metrics. They know your trends already because they do these loans on a daily basis. So you're not going to be able to pull the wool over their eyes, or it's going to show that you're extremely naive, that you don't know what your own metrics are and how you compare to your industry. And that is totally different from knowing who your competition is and how you're going to be able to, you know, have a competitive advantage and get more, you know, customers to come to you instead of going to them.
I can't overestimate the importance of knowing and showing your competitive advantage, whatever that happens to be. Now, I don't know that so Bob, let me ask you this. We're talking about making the pitch to the underwriter. What does the underwriter care about your competitive advantage?
They want to know that you know what it is. You need to understand your business. I mean, it's that simple. You know, if you don't know what your advantage is, then why do we want to make you a loan?
Okay, so I'm not just crunching numbers. These are critical things I want to know as well.
Every loan I've ever done has had an interview with the client and the underwriter. This is once it gets into credit. And one of the main purposes of that interview is for the underwriter to determine, does this business person really know their stuff? And if they don't, that's going to be a pass.
Thank you, Bob. So let's talk about what I need to be prepared to do right now to explain and to document my financial and operational performances.
Well, again, you're going to need to know your business. And in this instance, you're going to need to understand your historical business trends on the profit and loss statement. And you're going to need to understand your balance sheet, your debt load. You know, how are you burning off everything you get and not putting anything into retained earnings? You have a lot of shareholder loans out there. How's your AR performing? Is it turning the way it should be turning for the type of industry you're in? Are your sales trends going up? Or are they going down? Do you have stable cost of goods sold? Do you have any anomalies within your expenses? What does your EBITDA look like? So there's a lot of things out there that you really need to get a handle on. And you know, a lot of entrepreneurs will farm that out to a CPA firm to manage that for them. But if you're going for a loan, you're going to need to understand that yourself, or have an advocate with you that can speak on your behalf.
Yes, and it's always valuable to have that advocate who can speak for you. For example, one of the packages we're working on with the client, the CEO is one heck of a salesperson, and he is one smooth guy, but it's his financial person, and I'll just mention his name because nobody will know the business, Jay, that really has impressed the banks and given them the information. And the CEO has just stayed in the background on that. You have a good, strong relationship with what Jay's been able to bring to the table. Why don't you share how someone like a Jay in your organization can give you enormous credibility and what a company may need to do to prep their Jay to answer the bank's questions.
Jay is a unique individual in that he can discuss everything that has to do with the sales pipeline that's going on. He can tell you where the company is financially, and he's not a CFO. I think Jay's more analogous to a COO, but he's an engineer, and I guess because of his background, he's very detail oriented, so he can understand and discuss where every project is, where it is in the works, the legal aspects of the contracts, how it affects company performance, how it's going to affect the balance sheet and income statement, although he might not refer to them as balance sheets and income statements. He's talking about revenue and expenses. And he really gives a high level of credibility to the company, and that the senior management of that company really understands and knows what's going on.
So if you have a prospective Jay in your on your team, get them ready to talk to the bank for you. They will make a huge difference. Anything else you want to add to that, Bob?
No.
Okay, let's move on to the next slide. Bob's a weightlifter, so he was able to tell us how much this lady is about to bench press. And you can start with that, Bob, and talk about.
Yeah, I'll correct you. Clean and jerk, not bench press. You can
well,
tell by looking at Rich that he's a former bodybuilder.
So what do we talk? Obviously, agility in this marketplace is being able to show, when we go back to the pandemic, that you were able to do things to keep your business afloat. And it's not just more sales, but Bob, it's what are the things that you want to be able to show you've done? Because I know a lot of the businesses out there have already done it. They may not realize how important it is to the bank.
Yeah, and one of my former banks that I worked at had a good article on this. What they're looking for, as well as other banks, from the agility standpoint, is if you did experience a distress during COVID, were you able to pivot? That is to say, do something different to bring additional revenue in, keep operations going. Were you able to take advantage of some of the government assistance money that's out there, i.e. PPP loans, economic industry disaster loans, or any other grants your state may have? Were you able to go out and try to use as many resources to keep operations continuing? And you might not be at the profit level you were before, maybe you're 25% down, but operations are still moving forward. You haven't lost any customers. Maybe things have slowed down, but you've kept things going and you have a plan.
So in other words, you weren't a deer in the headlights, you were proactive, and they're not going to say, oh, so that's how you did it. You got PPP. They're going to say, congratulations. You took advantage of what was there in the marketplace for you.
You went out there and took advantage of what it was in the marketplace instead of running right to the bank.
So consider that a plus. Don't feel that you have to hide from the fact that you got an EIDL loan or PPP.
And know that loans like EIDL loans, the SBA at the end of the day will subordinate a facility like that to another SBA loan, like a 7A. So that's a plus. And of course, PPP, if you're using it as it's intended to be used, is forgivable.
Let's go to the next slide. So that takes us right into updates on PPP and EIDL. And the first thing I want to say is, at a blink of an eye, anything and everything can change in these categories. And then, Bob, I'd love for you to share with us some of the special programs that entrepreneurs need to be aware of that are available right now with new legislation?
Okay. Yeah, I mean, what I'm hearing from a lot of my banker buddies is if you had an initial round one PPP loan, a lot of the banks that at least my clients who got PPP loans went to, they're already being teed up by those banks for round two. So they're asking those clients to go ahead and get their updated payroll information and maybe a few other documents to be ready for when that porthole will reopen. And I think the 19th is the target date for a lot of them. But a lot of them are still meeting with the SBA trying to figure out, how it's going to work and what needs to be done. So that's there are more to come on that. Some of the smaller banks are I believe already accepting applications. EIDL loans, they're still open. There's there's certain things that you go to the website that says they're not ready for the $10,000 grant. It's all been used, but we're hearing that is probably coming back. So I would just keep going back to the SBA.gov website. And there's other programs out there. For example, for shuttered venues, there's a government grant program that's up to $10 million for, say, like the large box theaters, movie theaters, and entertainment venues that if you were shuttered or had to shut down due to COVID, there's potential grant money out there to help you get back on track. There's a webinar I'm going to go to at 3 o'clock that's going to talk more about that. But there are other programs out there. There's state level programs. I know I've seen some in Indiana and Ohio that are offering money to small businesses. So I would just go to your state Department of Commerce websites, and there's possibly other assistance out there as well.
So if I'm shuttered because I'm I'm a beauty salon, would that fall under that in that bucket?
No, that is only for shuttered venues.
So how are
and a venue means an entertainment venue like a movie theater or something similar.
Okay, I want to go back to PPP because a lot of entrepreneurs have struggled finding the right resource to file PPP through. And Bob, there are other sources like Cabbage that seem to own this process. What do you know about, what can you recommend about where you might go if your bank is, if you can't find a bank immediately to process PPP through?
Yeah, if your bank is only taking existing customers and hopefully if you're one, they should be taking you, but if they're not, then Cabbage is an excellent resource. There's several other, they're called fintechs, financial technology organizations that I have run a couple of client PPP loans through in the past. And it was pretty seamless. It was pretty quick and pretty easy. So I think that that would be one good resource to consider. And if you pull up Cabbage for PPP, it's going to automatically pull up 3 or 4 others along with it. I think Blue Vine is another one. So that would be a good route to go.
And aren't they also doing some SBA loans?
Yes, they are. I'm just really not familiar with that process. In my experience with fintechs who use algorithms and other programs to decision a loan, that's just, to me, that's just too impersonal. Maybe I'm behind the times or a dinosaur as far as that goes, but to do an SBA loan, in reality, you really need to be talking to a person because there's a lot of gray areas. You can't do you can do a deal where you just check off boxes and make a decision, but not everything is a yes or no. Not everything's a Boolean statement.
Gotcha. Let's go to the next slide.
You want me to spell Boolean for you, Rich?
I can't even pronounce it, Bob.
Oh, okay.
All right. So do we have any questions to answer right now?
We've got one question. What is the difference in process in dealing with a private company like Cabbage versus going to a bank?
Well, with Cabbage, you're dealing with an algorithm. With a bank, you're dealing with a person.
The other, but in terms of a PPP loan, it's
Yeah, and in terms, if it's regarding PPP, then that to me doesn't really matter. I've like I stated, I've run a couple of PPP loans through Cabbage, and it was seamless. It was great for that process. I highly recommend it.
and the only reason I think to go to Cabbage for an SBA loan is perhaps if you're considered a new business, which means you've been in business under 3 years, or you're at a certain size. Is that the way you assess it, Bob?
Yeah, if you're there's a lot of banks. Actually, most banks fall into several tiers. There's a group of banks nationwide that don't like to do anything below 500,000. There's another tier of banks that don't like to do anything below 350. And so, generally, if you have a bank, although they're all able to do that within the SBA, they just choose not to. If you're below 350, that's when you can start considering some of those fintech banks to go ahead and get an SBA loan done.
So if there's another question, let's go with it. Otherwise, I just want to ask Bob a few more things to share. Do we have any other questions on board right now, Andrea?
You're muted, Andrea.
Hold on, guys. All right, here we go. Someone wanted to know how the Capital Masters works with entrepreneurs.
Well, that's a wonderful question for us. What we came together to do was, in this difficult time, help entrepreneurs put together the right packages and the right focus to get bank financing. And that's our area of expertise, and we offer it in several ways. We offer a white glove approach, which is we take you through the whole process. And let's bring on the next slide. That'll show you. Let's go one more and then back to this one. If we take you through the whole process, we're basically, Bob is your bank financing coach, and he crunches your numbers and does all those things he talked about earlier in the program in terms of making sure you're properly prepared. And I'm going to let Bob address that because I know I'm slaughtering it. And
yeah, you are, Rich. Yeah, I don't just crunch numbers. I'm asking questions just like a coach would. I'm seeing what you know about your business and what you don't know about your business. And I'm looking for potential red flags and alerts that may crop up with a bank. So the number crunching, all that does is like going to your internal medicine doctor, gives me a little roadmap of what your health is. From there, that's when the questions start coming, and I start talking about, tell me about your competition, tell me about, what we discussed in the slides. So it'll be a pretty in-depth credit analysis to really see where you are, what you know, and what the potential risk of obtaining a loan is, or the probability of obtaining a loan.
And then you make sure that what goes into the package is to your best ability what a bank will need to make the right decision.
Yeah, it's going to be heavily weighted for the guy behind the curtain, or the person behind the curtain. Let's be PC today, I guess. So yeah, it's going to be heavily weighted towards the credit officers. And then of course, they're going to always do what they want to do. But it'll be there, and it'll show them that the due diligence was performed before we gave this deal to them.
So Bob, what I've seen you do is, before we even consider whether we can help someone, you ask for very specific information and you review that. And based upon that assessment, you determine if this is a good, viable loan. What are some of the things that you need to make that assessment?
Yeah, basically, I'm asking for 3 years of tax returns on the business, 3 on the guarantors, anybody who owns 20% or greater. I'm looking at resumes. I'm looking at personal financial statements, accounts receivable, accounts payable statements, balance sheets and P&Ls for an interim period, and maybe even last 60 days of bank accounts.
And once you have that number, that information, how does that help you decide if someone is ready to go to the bank?
Well, I mean, I'm not just collecting paper. I'm going to use all of that and perform analysis for many different directions. I'm going to perform a balance sheet and financial statement analysis. I'm going to perform cash flow analysis. Maybe looking at industry metrics, ratios on receivables turn. Be looking at guarantor liquidity. Be looking at credit report of the guarantors. Score doesn't mean anything, without going into the report and determining what their personal leverage is and their ability to service their own debt, and their ability to be a strong guarantor for the deal. I'm going to be looking at collateral. There's actually quite a bit that I look at.
So thanks for that, Bob. And then what we'll do is I'll work with you on the strategic side of your package and your business plan. And then Andrea and Marie are our bank marketing team, and they put together the package, and then we're ready to take it and shop it. That's what we call our white glove approach. Let's go back one slide and let you know about a program that's coming up January 25th. That's the kickoff date, and it's the Entrepreneurs Intensive Program. We're looking to work with a number of entrepreneurs and take you through every phase of the process. We'll still be the strategic coach, the bank coach, and the help you with the package. But basically, you'll put, rather than us doing it on a white glove, it'll be much less expensive because we'll be taking you through the process and you and your team will be doing it. Please go to our website, thecapitalmasters.com. There's a lot of free information that we're offering, and that there's a lot of information about this program and other programs that we offer. So I want to thank everybody for your time and turn it back over to Andrea.
All right. Looks like we've wrapped up all the questions. Rich, Bob, do either one of you want to offer some parting words or your best single thought? We have a lot of information here today, but maybe something in a nutshell before we wrap it up.
Well, I'd like to ask Bob to share an email he just received yesterday from a banker saying, yes, we want your business. This is what we want. This is what we don't want. And this is what's shaky. Well,
you just said it.
Well, go a little deeper in what he sent you, Bob.
Yeah, I was talking to one of the bankers locally here who was calling me looking for the propensity to get, some down the road business from me. And he sent me some information on his institution. And it was interesting. I hadn't seen it in that format for quite a while from any of the banks that I deal with, except for a couple. And there was one column that basically had all the industries that they liked, and they did. There was another column that said, these industries are pretty shaky. We're not sure if we like them, but we may look at them. And there was a third column that had about, 35 industries in there that said, we absolutely will not touch. And I mean, from one standpoint, that's pretty cool that, you can really hone down on what to give them and what not to give them. But at the same time, it shows a pretty high level of fear because some of the industries that they said they absolutely would not touch didn't really make a lot of sense. I mean, it does in a COVID credit environment, but some of those industries have significant mitigants and are really performing better than some of their peers. So I thought that was kind of interesting, but that's just kind of the flow that we've been seeing nationwide. For example, we got a $930,000 restaurant deal approved in Houston. And a lot of people are saying, well, how in the heck did you do that? Well, they kind of took the COVID aspect out of the mix and said, and it's pizza, by the way. So pizza is performing better during COVID than they did last year and pre-COVID. And what they did is they're underwriting that restaurant from the standpoint that all existing restaurants in that portfolio, which it's a franchisor and a franchisee combination applying for the debt, the existing restaurants covered the debt service based on their profitability of the new entity. So it kind of made a no-brainer deal. We had a strong guarantor as well. So that deal's getting approved and it's going to move to closing. So it's everybody's looking at stuff differently. There's a lot of fears out there of what's going to float and what won't float. And my suggestion is, if you are talking to a bank, be open, be transparent, and tell them the truth.
There's another story that I'd like you to share with us. One of our clients that we're working with, the loan officer really pushed hard on the deal, probably put in several hundred hours on it. And Bob, tell the story about what happened there and how he came back into the picture.
Well, I mean, we worked on this client of ours for about 3 months. COVID entered into there, so the underwriting process took a little bit longer. PPP was thrown in there too. So, but outside of that, this deal had been approved by the senior executive person at the bank on the sales side. It went past their public finance side. This was a public finance type deal. And it got through underwriting and was ready to go to signature authority. The credit team at the top changed. They left for whatever reason. 2 new guys come in, and a deal that was going to be approved for $2 million got killed by the new credit team because they didn't understand it. This guy put in a heck of a lot of time. I knew the gentleman personally. He had, in another life, had underwritten a bunch of my deals years ago and was at a senior level now. And what he did was he was so frustrated because of what happened that he went to another bank that he knew of pretty well, to one of his buddies who's now a senior sign-off authority and is representing the loan to that bank. And we may actually get it done. So it was a unique circumstance where the gentleman had put so much time to it that not out of guilt, but out of frustration. And he believed in the deal so much, he thought it needed to be done.
But let's talk about what's in it for him as well, because this is something that most of us wouldn't even begin to know is part of the banking world.
Well, most banks, not all banks, but most SBA banks, I'm taking commercial conventional out of the mix because they don't do this, will pass usually a half a point or a point referral fee for a deal that gets approved and closed at their bank. Since our contract is between our clients and ourselves, and it's more of a consulting rather than a brokerage deal, we're getting paid by our clients. So if there's a fee at one of those SBA banks, which in this case there is, he's going to be able to take advantage of that. I'm not sure how much of that, but so there's an additional financial incentive to maybe kind of sweeten the pot for him to get the deal through.
Thanks. That's important to know, that there are fees that banks are offering as part of their services. Bob, I want to ask you one last question.
But those fees are only for the people presenting. So if you're asking for a loan, that fee does not go to you.
Right, of course. The other question I wanted to ask you is there's a lot of pressure right now on the underwriters to get it right. And there always has been. Uh, so what are the consequences for an underwriter that writes a few loans that go south?
Termination.
And how about other consequences for the bank?
Well, I mean, depending on how many deals go south, the regulators could be in there scrutinizing their entire portfolio. They could be placed under audit by the SBA or FDIC. In addition to that, if it is an SBA-based organization, they could be in jeopardy of losing their guarantee. And one thing you learn working for an SBA lender is you need to protect the guarantee at all cost. Because even though you're getting, 75%, 85% in the CARES Act, I believe it's up to 90% to the end of the year. That doesn't mean that you need to be making idiot deals. You still need to use prudent credit analysis to ensure that this deal is a viable deal to the best of your knowledge and ability, and that it's going to be repaid. Because if you do have to request payment on a SBA guarantee, that's going to be a black mark for your bank.
Thank you. I may have misspoken when I said about the transcript. Andrea, what information do you have on how they can get access to this program one way or another?
Well, we'll be sending a link to the recording of this webinar. We'll also be putting it up on our YouTube channel, and YouTube videos do offer you an option where you can download a transcript of the video. So that is a place where people can get the transcript if they need it.
Okay. I think Bob and I have answered all the questions. And Andrea, would you like to just wrap it up in any way?
I would like to wrap it up. So as Rich said, they've answered all the questions. The good news is there is money out there. The challenging news is you've got to be buttoned up more than ever, and it doesn't hurt to know people who know people. But thanks again for joining us today. Watch your email for the link that I talked about that'll let you access the recording of this website, and for lots of other resources about getting your financial house in order and other things you need to make your business financially successful in 2021. You can visit our website, which is thecapitalmasters.com. And with that, we'd like to wish you a happy day.